Recently, I came across an article that mentioned BlackRock, a large fund manager, thinking about coming up with new valuation models because current valuations seem not to work. I think valuation models are important. They always come up when markets are dislocated or post dislocation, actually, and there's a good reason for that. This is the Not Even Wrong podcast. It's July 22nd, 2020. This is Krim Delco. Today the fund was up 3%. The market was up 0.5%. For the year, the fund is up 141%. The market is up 0.5%. So we're outperforming by about 140%. That means that if in January we start with $100 and the S&P start with $100, we would have $241. The S&P would have $100.50. Yeah, valuation models, the topic of today's episode. First of all, what is valuation and what is it actually used for? Valuation is the concept of assessing the value of an asset. Let's use equities for simplicity. So you have a company, and the company has to be valued in some way or form because investors, they pay a price for that company. They take equity of a company as in exchange for capital. So they have to have a sense for what that is worth. And that's what we call valuation. Valuation models have changed over the last decades, if not centuries. But in a way, they have changed and not changed. First of all, let me come up with some of the ideas that are prevalent right now. So we have the famous discounted cash flow model, which is a concept that I think has been around for centuries, if not millennia. It just had different names. And that is the value of a company is the discounted cash flows of the company until forever. So what you're trying to assess is, look, this company is going to throw some cash flows now and in the future, and the combined value of those cash flows all together, that is the value of the company. Now, of course, that is, on the one hand, a very precise way to think about it. On the other hand, it's a very vague way to think about it because, of course, who knows what the cash flows are going to be in the future. But nevertheless, it's a good concept. It's a concept which means that it's not necessarily it's not going to give you the absolute precise value of a company, but it's going to help you think about how to even conceptualize the value of a company. For example, Tesla is throwing off some cash flow now, but we expect a lot more cash flow in the future because we expect certain things to happen, such as Tesla dominating the market for autonomous driving robots and other energy products that are harnessing the power of the sun, for example. So that in itself should give us enough confidence that the value of the company today can be much higher than maybe the current cash flow justifies. There are other models that look at the value of the company. For example, they look at the dividend and they discount the dividend flows that come from the company and things like that. But I don't want to go on into those models because they're just the derivatives from the discounted cash flow model. So once you accept the discounted cash flow model as a way to think about the value of a company, you have to go and assess another factor which is very important, which is the risk-free rate. Any kind of valuation model, anything in computational finance starts with a risk-free rate. The risk-free rate is kind of like gravity. It's the opportunity cost of capital. It's where everything starts. So any kind of model, any kind of concept of value in financial markets has to start with the risk-free rate because you always have to ask yourself the following question. If I was not to take a risk, what would be my compensation for capital? The problem with that is that today we don't have a risk-free rate. The yield on a government bond, which is the risk-free rate in the United States, is 0 or negative. The real yield on treasuries is negative. So we have a completely dislocated risk-free rate market. Macroeconomists are concerned about that. They're talking about the lack of risk-free assets. Again, I don't want to go into that conversation. That's an episode on its own. But it's still very relevant to my conversation right now, which is the valuation of assets. Because no matter what, if we have a risk-free rate or not, the risk-free rate is the fundamental anchor of any kind of valuation model. And the fact that we don't have a risk-free rate right now is putting all the valuation models in havoc. And this is precisely the reason for why we have companies like BlackRock and many other fund managers almost desperate, trying to figure out what's going on in the market, how to value things. And the interesting thing about financial markets is that the financial markets are like water. They do what they need to do. They go down the path of least resistance, and they always find a way. It's us humans that have to conceptualize what's going on. And in that sense, I think we have created, and I keep saying that the most amazing artificial intelligence that humans have created are the financial markets. And they still are much, much more advanced than any other AI that we have, because they give us information about things that we don't know ourselves. So anyway, so let's get back to this concept of valuation. We don't have risk-free rates, so we have to think about something new. What can we do? How can we conceptualize valuing risk assets in a world without risk-free rates? Well, there's two ways. We can try to figure out what is stuff worth without a risk-free rate, or we can try to find a new risk-free rate. For example, the yield on bonds of Apple or Microsoft or companies like that issue bonds, even though they obviously have a lot more net cash on the balance sheet than that. They still have bonds, and there is some sort of yield for those types of companies. So maybe that would be an approach. I personally don't like that, because no matter how safe a corporation looks, it doesn't have the safety of a government. A government bearing any kind of revolution or anything like that is by definition a risk-free asset, because the government can always decide to either print money or tax people and finance any kind of debt that they have to pay back. So therefore, I suggest we start thinking about valuation models without the availability of a risk-free rate. So we have to really go into uncharted waters here, valuing stuff without a risk-free rate. So how could we do that? I think one way to think about it is to assume that the opportunity cost of capital is still non-zero. It's just that we have a deflationary environment, and therefore capital is valuable or gains value just by sitting under the pillow. This is one way to think about it. So you can argue that money, instead of losing value, gains value, because in a highly indebted economy with disruption, and that's what we have right now in the US, a lot of debt and disruption, there is the potential for a deflationary environment, and therefore money gains in value. And therefore there is an opportunity cost of money, because by not spending money, by keeping it under your pillow, you're earning interest. Now, again, this is a little bit, it requires imagination, because we have zero interest rates. So where is that interest? Well, the interest comes from the purchasing power of money, which is gaining through time because we have a deflation. These are very complex concepts, and macroeconomists are, writing PhDs en masse to try to explain this. What I'm trying to throw out there is that we have a situation where the opportunity cost of capital still exists, and it's in a deflationary sense, and therefore assets do have a kind of a risk-free rate to be valued at. Another way to think about it, maybe in a bit easier terms, is instead of using a nominal interest rate, you can use a real interest rate, because if you add the expectation of inflation, which is negative. So if you add that to the zero risk-free rate, then you get a positive real interest rate, and then you can value assets accordingly. Now, in a deflationary environment, of course, things change dramatically. For example, companies that have growth are a lot more valuable than companies that don't have growth. That, of course, is always the case, but it is much, much more accentuated in a deflationary environment, because if you don't have real organic growth in a deflationary environment, you really don't have growth. And therefore, I think that's one way to explain at least the large relative discrepancy of valuations between growth companies and non-growth companies, or the outperformance of disruptive companies such as Tesla, Square, Microsoft, Amazon, Apple, Google. These companies have growth, real organic growth, and relative to other companies like Coca-Cola, utilities, energy companies, food companies, they don't rely on inflation and price increases to generate growth. And this is one of the main reasons why they outperform. Now, this model helps understand what's going on. It obviously doesn't help the precise valuation of things, although I would argue that that is never the case. You can never precisely value something, but what's really valuable is to have a sense for relative value. And my expectation is that we're going to see a lot more extreme valuations of real growth companies. I've said that before. You can see price earnings ratios of 50 to 60 in companies like Microsoft or Apple or Amazon, maybe 100, because it is a function of growth. So if you have a company that grows in real terms 10%, it can have a 50 to 60 price earnings ratio. A company that grows 20% can have a 100 price earnings ratio, and a company that grows more than 20% can have a much, much higher price earnings ratio. This is very controversial. I know some people will tell me that I am probably just disillusioned and I don't know what I'm doing, and it's probably just because I don't have a better explanation. I'm just throwing these numbers out. I have a fairly high confidence in a deflationary environment with disruption, real growth will be unbelievably valuable, because that is the scarce asset. Thank you.